Right now, in your bank account, there's a number. Let's say it's $10,000. You believe that money is sitting in a vault somewhere, safe, waiting for you. It isn't. If you and every other customer of your bank walked in today and asked for your cash, all of it at once, your bank would run out of money in hours. Not because it's badly run, not because it's committing fraud, because that's how every bank on earth is designed to work. Today, we're going to answer a question that sounds like a thought experiment, but has actually happened again and again in real history. What happens if everyone withdraws their money today? The illusion of your money in the bank. Let's start with an uncomfortable truth. When you deposit money in a bank, it stops being your money in any physical sense. It becomes a loan you've made to the bank. In exchange, the bank gives you a promise, a number on a screen that says you can ask for that money back whenever you want. But the bank doesn't just let that cash sit there. That would be a terrible business. Instead, it takes the vast majority of it and lends it out. Mortgages, car loans, business credit lines, credit cards. It also invests some in government bonds and other assets. This system has a name, fractional reserve banking. Banks are only required to keep a fraction of deposits available as cash reserves. The rest is out in the world, tied up in 30-year mortgages, 5-year auto loans, and long-term investments that can't be turned back into cash overnight. So if you check your banking app and it says $10,000, only a small sliver of that, often just a few percent, actually exists as physical or instantly accessible cash in that bank's vault or central bank account at any given moment. This isn't a scandal. It's literally the business model. Banks make money on the difference between what they pay you in interest and what they charge borrowers. Without lending your deposits out, banks couldn't function, and the economy would grind to a halt because nobody could get loans for homes, cars, or businesses. The system works beautifully, as long as everyone doesn't want their money back at the same time. The mechanics of a bank run. So what actually happens hour by hour if that everyone scenario kicks in? Hour 1. The queue forms. Word spreads, maybe through a rumor, a news story, or a viral post that a bank is in trouble. People don't wait to find out if it's true. They rush to withdraw before their neighbor does. This is called a bank run, and the terrifying part is that it doesn't require the bank to actually be insolvent. It only requires people to believe it might be. Hour 2 to 6. Reserves drain. The bank starts paying out its available cash. ATMs run dry. Branches start rationing withdrawals or shutting doors early. Because remember, the bank never had everyone's money in cash to begin with. Hour 6 to 24, emergency borrowing. The bank tries to raise cash fast. It can borrow from other banks, sell off assets at a loss, or turn to the central bank's lender of last resort facility. In the US, that's the Federal Reserve's discount window, but selling assets in a panic means selling cheap, a fire sale, which weakens the bank further and can spook other banks watching the same thing happen to them. Day 2 onward, contagion. Here's the part that turns one bank's problem into everyone's problem. If Bank A fails or looks shaky, depositors at Bank B start to panic too, even if Bank B is perfectly healthy. Trust in banking isn't bank specific, it's systemic. This domino effect is called contagion, and it's the exact mechanism that took a regional housing problem in 2008 and turned it into a global financial crisis. Days to weeks, regulatory intervention. Eventually, governments and central banks step in. Deposit insurance payouts, emergency loans, mergers, or in the most extreme cases, nationalization. But this takes time, and time is the one thing a bank run doesn't give you. But we have deposit insurance. Doesn't that fix this? Good question. Most developed countries have deposit insurance specifically designed to prevent this exact scenario. In the United States, the FDIC insures deposits up to $250,000 per depositor per bank. In the EU, it's 100,000 euros. The UK's equivalent covers 85,000 pounds. The psychological purpose of this insurance is arguably more important than the financial one. If you know your money is protected, even if the bank collapses, you have no rational reason to rush to the ATM. Deposit insurance exists to stop panic before it starts. It's a confidence machine, and it mostly works. Bank runs are much rarer today than they were in, say, the 1930s, precisely because of this guarantee. But here's the catch, and it's a big one. Deposit insurance funds are not sized to cover a full-blown, nationwide, everyone at once withdrawal. The FDIC's insurance fund holds a small percentage of total insured deposits, nowhere near 100%. It's designed to handle isolated bank failures, not a systemic panic across every bank simultaneously. If genuinely everyone, not just customers of one bank, but the entire population, tried to pull out their money on the same day. Deposit insurance couldn't cash everyone out instantly. It would need government and central bank intervention on a massive scale to even attempt it. Scale it up. What if the entire country does it? Let's push the hypothetical further. Not one bank, not one city, every account holder in an entire country withdrawing everything today. Step 1. Physical impossibility. There isn't enough physical cash printed to cover it. Central banks keep only a fraction of the total money supply in circulating paper currency. The vast majority of money in an economy exists only as digital ledger entries between banks. You can't print trillions of dollars in banknotes overnight. The physical printing and distribution infrastructure simply can't move that fast. Step 2. The banking system freezes. Banks would halt withdrawals, either informally through technical issues and long lines, or formally through emergency measures. Governments have done this before. It's called imposing capital controls or a bank holiday. Franklin D. Roosevelt did exactly this in 1933, closing every bank in the US for 4 days to stop a nationwide run before it destroyed the entire system. Step 3. The stock market and credit markets seize up. Banks would have to call in loans, dump assets, and stop lending completely to raise cash. Businesses that rely on short-term credit to make payroll or buy inventory would suddenly find that credit gone. Even healthy, profitable businesses can collapse in days without access to credit. This is exactly what nearly happened to the global economy in September 2008. Step 4. The central bank becomes the only option. The central bank, the Fed, the ECB, the Bank of England, whoever it is in your country would have to step in as the ultimate backstop, effectively printing or creating new money to meet demand. But this has consequences of its own. The inflation problem. If a central bank floods the system with newly created money to satisfy every withdrawal request, it doesn't magically create new goods and services to match. It just creates more currency chasing the same amount of stuff. That's the basic recipe for inflation, and in extreme cases, hyperinflation. We've seen this play out in real history. Weimar Germany in the early 1920s, Zimbabwe in the late 2000s, where inflation got so extreme that the government eventually issued a $100 trillion banknote, which, at the peak, could barely buy a loaf of bread. Venezuela in the 2010s saw similar spirals. In each case, the pattern rhymes. Confidence in a currency or banking system collapses. People rush to convert their money into something, anything, more tangible. Foreign currency, gold, real estate, even goods they can barter with. That rush itself accelerates the currency's collapse because a currency's value depends almost entirely on collective belief that other people will accept it tomorrow. So in our everyone withdraws today scenario, even if the government could somehow print enough cash to hand out, doing so would risk destroying the value of that cash in the process. You could end up holding all the money you wanted, and it could buy you almost nothing. What would actually happen in practice? Let's be realistic instead of purely theoretical. If mass withdrawal panic started building today, here's the more likely real-world sequence. Digital withdrawal limits kick in first. Long before physical cash runs out, banks and payment systems would throttle transactions, daily withdrawal caps, delayed transfers, app maintenance outages. You've likely already seen smaller versions of this during past banking scares. Markets would crash in parallel. Bank stocks would plummet. If it's contagious enough, broader stock indices fall too, since banks are deeply interconnected with every other part of the economy through lending. Governments would intervene fast, not slowly. Modern central banks learned hard lessons from the Great Depression in 2008. And coordinated statements from finance ministers are now standard tools to stop panic in its tracks. In 2008 and again during the 2023 regional bank stress, Silicon Valley Bank, Signature Bank, regulators moved within days, sometimes hours, specifically to prevent contagion from spreading further. Trust, not cash, is the real currency being fought over. Every intervention, insurance guarantees, liquidity injections, bank holidays, exist to answer one question for the public. Should I still trust this? The actual cash matters less than the psychological signal that the system is stable. Why this scenario is both terrifying and mostly unlikely. Here's the paradox worth sitting with. Bank runs are a self-fulfilling prophecy. A bank that's perfectly solvent can be destroyed purely by the belief that it won't be. And a bank that's genuinely in trouble can sometimes survive if enough people simply don't panic. This is why governments treat confidence in the banking system as a matter of national security, not just economics. It's why deposit insurance exists, why central banks act as lenders of last resort, and why officials go out of their way to publicly project calm during any hint of banking trouble, because the narrative itself is part of the mechanism. For everyone withdraws today to actually happen, you'd need a total collapse of trust across an entire population simultaneously, something that historically has really only occurred during full-blown national crises, hyperinflation episodes, currency collapses, wars, or the failure of an entire banking sector like in Greece in 2015 when capital controls limited withdrawals to just 60 euros a day. Notice the pattern in every real example. The withdrawal limits, the bank holidays, the emergency intervention, they all happened because the system anticipated this exact nightmare and built safeguards specifically to prevent it from spiraling out of control. So, what happens if everyone withdraws their money today? In the short term, chaos. Empty ATMs, frozen apps, panicked headlines, and a banking system that simply cannot physically deliver on every promise at once, because it was never designed to hold everyone's money in cash simultaneously. It was designed to hold trust. In the medium term, emergency intervention, central banks and governments stepping in with the liquidity, guarantees, and, if needed, outright restrictions on withdrawals to buy time. And in the long term, if trust isn't restored fast enough, currency devaluation, inflation, and economic damage that can take years to repair. The entire modern financial system runs on a quiet, collective agreement that we won't all cash out at once. It's a system built on shared belief, and like most things built on belief, it's remarkably strong, right up until the moment enough people stop believing.